proceedings. Before she really starts, I request participants to post their questions in Q&A sections. What we have decided is that we'll take up the questions and we'll allocate a special time of 15 minutes at the once she's completed her talk. So please accumulate all your questions and keep it in Q&A session so that those can be addressed. So Padmashri, please take over.
Thank you so much, Yogesh, and thanks CTC for providing me this opportunity. Thanks, Deepak, for all the coordination. So without wasting much time, I will just quickly try to present my screen. Please confirm if you can see my screen and hear me clearly.
Yeah, Padmashri, screen is visible and you are audible.
Yeah, thank you so much. So just before we start off, I think a brief background and why this came and why this was even actually a project to start off with. The indentation or the intention to do something of this sort. When we were discussing in one of the committees, one of the thoughts that came across is that is too much of non-standardized reports, non-standardized financial statements that are actually strewn everywhere. And also there have been some observations from Income Tax Office and other offices wherever these non-company financial statements. So what we are talking about is the population of non-company financial statements. That means without Schedule 3. So there were even instances of people actually certifying directly the tally balance sheet because there was no format as such. The compliance with accounting standards actually were largely discounted, if I have to say that way. Because when we talk about non-company financial statements, I wouldn't blame anyone, but it is our practice that we directly think of Income Tax Act. We forget that there is something as an accounting standard. For example, as basic as charging depreciation. As per accounts, it has to be in accounting standards. As per income tax only, it is as per Income Tax Act, right? So the determination of useful life, calculating the residual value, decommissioning expenses, all these are never thought of. And what we are talking about, it's not only small, tiny kind of establishments. There are good, reasonably good and larger LLPs and larger partnership firms also, where they actually these concepts will be very much applicable. So as a background, when we discussed on that topic, we tried to collate what are the types of deficiencies that we have. So mostly no one had notes to accounts. Mostly no background of the entity, no detailing about what is it into the business of, inventory disclosures, related party disclosures, all these were not there, which were actually mandatory as per the accounting standards. So if you pick up any balance sheet or financial statements of that sort, then you will say that this is not compliant with the basic accounting standards. So that is where we started off with. And then when we thought that what should be the format, well, that was the next question. So when we talked about the format, then we said that, there is nothing other than, because there is a line that is written in the Companies Act itself, which says that that doesn't mandate actually, but that says that, the number of if any other balance sheet is to be drawn by any other entity or company or any other related entity, it should be as near to as Schedule 3. So that was the first reference. However, not everything that is there in the Schedule 3, especially the new Schedule 3, that has got a complete full-blown section on regulatory matters like Benami transactions and, how did you do the loan and other things. All those things were not applicable. So I tried to kind of made a format which is actually largely in use, which is in customs and practice, but kind of reduced it not to be over cumbersome, or it should not be becoming a burden on the preparers of the financial statements. So that is the thought right now. Initially, this was a project launched by WRC, where we made the model financial statement. So ASB actually in their meeting like this, like this very much, and then they took it up, and then we also contributed to technical guide on financial statements, and it is as I understand from others, it is in the it is on the path of becoming a guidance note. So the authority statement that is attached to any models or any kind of illustrations that are released by WRC, it is for the benefit of everyone. When it becomes a technical guide, so that means it is to guide the members in larger perspective. When it becomes guidance note, then it will be mandatory for us as practicing chartered accountants to comply with it. So we are on the second step of the route. We are going to be on the third step. So this has already come from more than a year now. So this is the right time that we have to step up. So anytime sooner it becomes a guidance note, you are not left with a choice but to comply with it. Then you can't say that, then we will not be in a position to say that I didn't knew it, I thought it will come later, how to do it right now, because we have that luxury of time right now, and we should be able to comply with it. So that's the brief background about why this happened and what is it that we looked at. So before we understand the format will be is as good as the normal balance sheet format. I would like to discuss some of the nitty-gritties of applicability of accounting standards. What is the criteria for classification? What is the new announcement and how does it deal with it? And then go to the the last section. I also have some FAQs which are there in the publication, as well as some extra FAQs, just as a refresher for all of us to understand what it is there. So there was this announcement as on 31st of March 2021, which was relating to applicability of accounting standard on non-company entities. What is non-company entity? Anything that is other than a company. So other than a company and a body corporate. So it is all non-company entities. So you will see technical guide in two parts. One is for LLP because that is a body corporate, and one is for everyone else, that is sole proprietor to partnership to everyone. What is the scope? This does not apply to something where there is a statutorily defined framework. For example, cooperative banks, societies, housing societies, if any trust that is governed by any charitable, for example, Bombay Charitable Public Trust Act, the formats that are there, this won't be applicable to them, but the additional disclosures can be freely provided. So what did that announcement say? That it has from 1st April 2021, you have to ensure that you have to have this entire framework applicable. Okay, as we all remember, accounting standard had only three levels: level 1, level 2, and level 3. What did this announcement do 2 years ago? Is that it added one more level. So now we have 4 levels of entities to which different accounting standards are applicable. And these accounting standards step by step are applicable to these 4 different levels. And accordingly, we have to decide what is applicable where. So first of all, let us understand the levels. Determination of the level is very important. Why? Everything starts here. Because accounting standard applicability starts here, disclosures start here. So it is very important to understand the levels, level 1, 2, 3, 4. Generally, when I interact with many of my colleagues and others, the mindset is that still we go back to 3 levels only. The 4th level is forgotten because, or it is not refreshed, I would say. There is a 4th level also existing now. It's not only 3 levels. Let us look at what are the levels. So the classification of levels is based on turnover, borrowing, and other criteria. Only level 1 has very typical first line item, which is entities whose securities are listed or are in the process of listing on any stock exchange, whether in India or outside India. Important question. The large thought is that, please don't take me otherwise, but I'm just putting up the thoughts as it comes or as I gather. So the larger thought is that only companies can get listed, which is not right? So there are other type of entities also which can get listed. For example, alternate investment fund, mutual fund, there is this venture capital fund. Then there is some opportunity for LLP to get registered in some countries outside India. So if it is listed on any stock exchange in India or outside India, then those are the entities that are distinctly different and it will be level 1 entity only. So please ask this question to your client or you try to find it out. So it doesn't matter whether it is listed on this SME stock exchange in India or outside India. If any of the if any of the securities are listed, if any of the entity is listed rather, then it becomes a level 1 entity of non-company entities. What is next thing? Banks. So banks, we all know we have different categories: nationalized bank, private bank, then foreign bank, then public sector bank, and then the cooperative bank. So cooperative bank doesn't get covered in any of the four. So this is something that will be level 1 entity. Financial institution, if it is in the form of any chit fund or anything that is actually working as per RBI guidelines, but it is not a company, then this is level 1 entity. Or any entities carrying on insurance business. As of now, insurance company has to be a public limited company. So right now there is no insurance company that will fall under this category. Okay, all these are level 1. So in the level 1, these two are the most important and very distinct things. Other things are determinant in every other level. So any entity where securities are listed or in the process of listing in India or outside India, and also anything that is a bank, other including cooperative bank, financial institution or entities carrying on insurance business. If these are there, this is Pakka level 1 entity. Now, other categories for considering level 1 entity. Wherever the turnover is more than 250 crore. So now we are talking about engaged in commercial, industrial or business activity. If you look at the framework for accounting standard, there is one important thing that is written, that accounting standard are applicable to every entity which actually participates in commercial, industrial or business activity. So there is always a question that when a charitable organization, even if one component of it actually is for commercial, industrial or any kind of business activity, then accounting standard gets applicable to them. That is very important to remember. I'm just spending 5-6 minutes on this because this is the base, and once we build the foundation stronger, the building will be obviously stronger. So the next criteria is 250 crores. So turnover is more than 250 crore other than other income. So we have to exclude other income, and normal turnover has to be more than 250 crore. All entities that are engaged in commercial, industrial, business activities having borrowing more than 50 crores, 250 crores, turnover 50 crores, borrowing. Holding and subsidiary entities of any of the above. What is holding and subsidiary of any of the entities above? So, not going into Ind AS, I'm just restricting myself to accounting standards here. So, whether a LLP partnership or a trust can have subsidiary. So, there are different views that float here, but then yes, with respect to significant influence, with respect to controls and other parameters that are there, then it is definitely possible to have a subsidiary here. So that is where it becomes necessary to consider if any of these entities have a subsidiary or a holding, then it actually gets into level 1 automatically. So level 1 is wherever it is listed or is in the process of listing, bank including cooperative banks, financial institution or insurance, and anything where turnover is more than 250 crore and borrowing is more than 50 crore, and also holding subsidiary of the above. Next level is easier. This talks about 250 and 50. So next level is turnover between 50 to 250 and borrowing between 10 to 50. So every other level is determined only by turnover and borrowing. So this was 250 above and 50 borrowing. This is borrowing between turnover between 50 to 250 and borrowing between 10 to 50 and any holding subsidiary of the same. Then level 3 entity is next step, that is 10 to 50 is the turnover, and then the borrowing is 2 to 10. So 2 is a very small amount, almost everything gets covered here. If you see level 3 entities, so 2 to 10 is the borrowing limit and any holding subsidiary of this. And then level 4 is obvious, where turnover is less than 10 and this also is borrowing is less than 2 CR. So that's the residual figure. So we have 4 levels now, and please remember these criteria. What is the thing that we should do when we are actually either preparing the financial statements for the client or we are auditing the financial statements? Number 1, please make a small checklist in Excel which actually puts this if and but formula and determines what is the level of the entity. That's step 1, which we have to necessarily do, without which actually it will not be appropriate to proceed further. And now let us look at what are the accounting standards that are applicable for each of these level of entities. So I have not put in here the level 1, because for level 1, all the accounting standards will be applicable. Okay. So let's run through quickly. Level 2, 3, and 4, AS1 and 2 are applicable. AS1 is basically about accounting policies and 2 is about inventory. So these two are by default applicable to all the types of entities, irrespective of the size and what is the type of what is the size and what is the nature of the this thing. Only if it is a service entity, then maybe inventory is not applicable. Otherwise, it is largely applicable. AS3 is not at all applicable to 2, 3, and 4. It is only applicable to level 1 entities. Now, there is a possibility that many people ask this question, that if it is a non-company entity, why am I supposed to give cash flow? But if it falls into category that is level 1, then you are mandated to give cash flow, because that is what is the requirement of the accounting standard. Then level 4 AS4 is applicable to all. AS5 is also applicable to all. These are all normal ones, subsequent event, prior period, and all that. Then AS7, if you have construction contracts, then definitely this is applicable. AS9 is everywhere applicable because it is a revenue standard. AS10, for level 2, it is applicable. Level 1 is anyways applicable. But 3 and 4, there are some disclosures. We are going to look at the exemptions also. Then level 1, AS11 is also similar. Level 1 and 2, it is applicable, and 3 and 4, you have got exemption. 12, if you have grants, it is everywhere applicable. 13, if you have investments, everywhere applicable. In level 4, there are some exemptions again. 14 is applicable. Now, how come 14 is applicable? So, when you have merger, acquisition, anything between the firms or anything, so when you are accounting for, it is like this, that if you are accounting for based on the methods that are provided in the accounting standard, then you have to use the accounting standard. If you don't have, then you don't have. But if you're using, then you have to definitely use as per AS14. There is one disclosure note, which is note 2C and 2D. We will come to those notes also. We will see that note as well. AS15, everyone is aware, it is more on the basis of number of employees. So level 1, everything is applicable if the number of employees are exceeding, and 50 and 52, 150 and things like that. So if you have for 2, 3, and 4, it is depending on the size of the entity and the number of employees. So accordingly, it will vary. 16, everything is applicable because it's only about the borrowing costs. 17 is not at all applicable because it's a segment, and segment won't be applicable for any of these entities. Related party is applicable till level 2 only. For level 3 and 4, related party will not be applicable. Then lease, it's applicable to first level, but others we have some exemptions, some table exemptions we have. 20 is not at all applicable to anyone. 21 and 23 and 27. So if at all you are thinking of consolidating into the entities into say, for example, a trust and another non-company entity, then you have to follow the principles of 21, 23, 27. So 21 is consolidation. Then 23 is also relating to consolidation of equity method of assets and associates and other things, and 27 is jointly controlled entities and jointly controlled operations. So these three are anyways applicable. If you are doing consolidation, you have to do as per this principle. If you are not doing, then it is not applicable. So that's what the note says. 22 is applicable. That is deferred tax. And then in level 4, there is a specific transition provision which will come to, and that is actually a carve out, if you say, and that is very specifically applicable to level 4 only with certain exemptions. 23 we spoke about. 24 is applicable only till level 2. 3 and 4 it is not applicable. 26 is applicable till level 3, but level 4 we have got some exemptions. 27, which is JV, we spoke about. 28 also, large amount of disclosures are applicable or not there. 29 is very much not applicable or with exemptions. Let us look at AS applicability charts a little bit. So we talked about note 2C, if we remember, at 2-3 places. So this is the note 2C. in case of level 4 entities. Generally, there are no such transactions that are covered under AS 14, but if at all there is something, then you have to follow only AS 14 and 27 as the case may be. Similarly, note 2D, what it says is all about if you are doing consolidation, then follow the principles of 21, 23 and 25. If not, then it is not applicable. When we have understood what is applicable and not applicable, we should also understand what are the relaxations and exemptions that are available, because we are talking about preparation of financial statements of the accounting of the non-company entities, right? So let us look at the relaxations and exemptions list. So I have not mapped all the accounting standards here and said that what all is applicable. Rather, I have taken the approach to only map the relaxations or exemptions and list it down so that we have a reasonable visibility on what is applicable basically. So when we talk about accounting standard, we saw this chart. So another, small tip here is that you can make a simple checklist in which you can map this, and then based on level 1, 2, 3, those get highlighted, and you are, while checking, you are compliant with the respective tables. AS 10, what is the exemption? There is in para 87 of AS 10, there is an encouraged disclosure. Now, this is not a mandatory disclosure even for the entity for where the entire AS 10 is applicable. This is only a encouraged disclosure. What is the encouraged disclosure? An enterprise is encouraged to disclose carrying amount of temporarily idle PPE, gross carrying amount of fully depreciated PPE that is still in use. For each revalued class of PPE, carrying amount of assets if they are carried out under cost model, carrying amount of PPE retired from active use and not held for not held for disposal. So these are the recommendatory encouraged disclosures. So this is not applicable to any of the levels there. It's not applicable to level 3 and 4. So it is still encouraged for 1 and 2. But then even in companies, these things are very seldom given. These are not something that are actually given quite often. But this is completely exempt for 3 and 4. 1 and 2, if they prefer to, this is still an encouraged disclosure. They can go ahead and give that. In AS 11 also, there is one encouraged disclosure. Enterprise is required to disclose foreign currency risk management policy. If you remember, some of the entities have this long 2-page note on foreign currency risk management policy. So that happens only when you have heavy exports and things like that. But you may think that how is it applicable in case of LLP or partnership? If I have to give an example, say many of the partnership firms have this export business. So then there is a lot of foreign exchange currency fluctuation that happens. So for such cases, it is very much applicable. So for example, there are various exports, agricultural products, some other products, and exports business is quite common. So if that is there, then this will be applicable. However, this encouraged disclosure is not applicable for 3 and 4. Accounting for investments. So in para 35F, there is other disclosure as specifically required by relevant statute governing the enterprise. So what is this relevant statute governing the enterprise? For example, AS 13 is not applicable to mutual fund because most of it is mark to market and things like that. So that statute or the mutual fund regulation, for example, gives a specific disclosure. So that disclosure is to mandatorily come. But however, the disclosure as per AS 13 is not applicable and accordingly it will not come. And the said disclosure as per the statute, it is not applicable to level 4 also. So actually that note that we say that this is as per this and as per this, that you can accordingly modify. Employee benefits. There are 3 to 4 slides running into employee benefits, but let us understand first this thing. In level 2 and 3, non-company entities, where average number of employees during the year is 50 or less, actually that's a typo error, 50 or less, are exempted from the applicability of 11 to 16, that is recognition and measurement of short-term accumulating compensated absence. So that's leave encashment, which are non-vesting. So leave encashment, the said recognition measurement principles are not applicable. 46 to 139, that is discounting of amounts. 50 to 116, 129 to 139. So these are not applicable. What does these paras deal with? It's mostly with the actuarial valuation, as you all know. So if it is crossing 50, then you have to have the actuarial valuation and you have to give the entire table. So generally, as we talk about, in common parlance, it's like if it is a non-actuarial valuation report financial statements, then it is only 3 tables, because P&L, balance sheet, and then whatever is the provision basis of the provision. So when it is actuarial, it goes into 6 to 7 tables. That is actuarial assumption, experience adjustment, your plan assets, your fair value of plan assets, residual, P&L, balance sheet, and all that stuff. So that's the detailed disclosure of AS 15 that you are looking at, in case actuarial, non-actuarial is applicable or not applicable. Now, many of the entities, we come across this question of whether why is actuarial important, or why is it even relevant? So, one answer is that it is required by the statute and it is required to be done by them. Now, the next question that comes after that is, in case the company has not complied with actuarial valuation, how do you actually report it? So when you have to report it, you have to quantify. How do you quantify? Because it is actuarial assumption, you will not be able to quantify. And what does your standard on auditing say? That if you are qualifying, you have to have the quantification, you have to have the you have to have the relevance on the profit and loss, or on the asset and liability. So here you will have to end up writing that it is unascertainable at the current time, or it is unascertainable currently. So this becomes an important thing. Many places, applicability of this actuarial valuation is something that actually needs a detailed evaluation. So it has to be taken care of appropriately. So this is similar, and this goes on level by level. Next, let's come to AS 19, which is more on leases. So let's explain, let's understand this again in principle, because there are 5 slides on this. But the essence of this is, you have 2 pieces in AS 19, operating lease and finance lease. Under each of these, there are 2 types of accounting, that is for the lessor and lessee. So operating lease, lessor, lessee; finance lease, lessor, lessee, right? So when you have the disclosures, you will have minimum lease payments. You actually look at the reconciliation between the MLP and the receipt and the present value. Also, you give the table, the lease outflow for, not later than, that is within 1 year, 1 to 5 year, and then more than 5 year. And also the total expected MLP, sublease payments, in case if you have sublease, what is the total expected value to be received under non-cancelable sublease prices, sublease pieces. And then the description of the lessee significant leasing arrangements, which also talks about contingent rent payment, existence of renewal of, repurchase, all this detailed evaluation that you give in the books of lessor/lessee, as the case may be, under operating and finance lease, is not applicable to level 2, 3, and 4. So in short, what is not applicable? That table where you give less than 1 year, 1 to 5 year, more than 5 year, and reconciliation between the MLP and present value, and also the description of purchase option is available, this is available, this is the description of the lease, these are the terms and conditions. So that specific portion is not applicable. Now, one question here is, only these disclosures are not applicable. There is no exemption in accounting here. Accounting has to still follow the same route, which is operating, finance, lessor, lessee, how to account for, all that has to happen. Only these detailed disclosures are not applicable. So there should not be any confusion within us as to whether we are exempt from accounting itself. There is no exemption from accounting. However, there is exemption only from disclosure. So there are 4 different pieces, as I said. So there are 4 different slides on the same. if you see. Okay. Now, when we come to AS 22. So what is AS 22? AS 22 is our taxes on income, right? So many people think that there is no deferred tax applicable if it is a non-company entity, which is inappropriate. Why? There are examples where you can actually have deferred tax. One example I gave at the beginning is depreciation. So when we think about depreciation for a non-company entity, we directly jump to the conclusion, take income tax depreciation rates and directly do the balance sheet as per the income tax depreciation. This is not in line with accounting standard. Have we looked at the useful life? Have we looked at the residual value? Have we looked at when is the revaluation required? We have not looked at any of these aspects as per the accounting standard. It is necessary. So if we start doing that, okay, so maybe let me take a very simplistic example, which is maybe a laptop or something, right? So you have a very high depreciation rate in income tax up to 60% in the first year. However, if you estimate the useful life, for 4 years, then your depreciation is 1/4 in each of the year. However, as per income tax, it is a different rate. So you have a DTA, DTL arising there. This is one example. Second example is all your 43B payments. So you still have some provisions, you still have some deductions or disallowances on which you will end up paying taxes. So these are some examples which I can think of, and there are large and complex entities which are actually non-company entities where DTA can very much arise. We should come out of the thinking that DTA, so generally what I have heard is, oh, it's a partnership, DTA not applicable. No, we can't conclude like that directly. There has to be an assessment done. There has to be these, items seen properly, and then only we can conclude on that. So following requirements of AS 22 are applicable to level 4 non-company entities. Level 4 entity has to only disclose the current tax. There is no deferred tax requirement listing that is requirement here. Now, there is one transition requirement over here. On the first occasion, when a non-company entity gets classified as level 4, so how do you determine? First time it is level 4. So say for example, last year financial statements you have to take, and based on that, what is the level 1, 2, 3 you have to determine. It was say level 2 last year, due to whatever reason this last year, and last year it was determined to be level 4. That means at the end of the year it became level 4. So based on that, if it is this year, if it is level 4, that is 4. If it is 21, 22 is level, end of the balance sheet is seeming to be level 4. That is your turnover criteria 2 to 10 and your borrowing is less than 2. Then for 22, 23, if you have DTA, DTL accumulated in your balance sheet, then that has to be actually charged to your opening revenue reserve. So this is one transitional adjustment that is very necessary when the change in the level happens. Now coming to AS 26, intangible asset. So in the intangible asset, we give that table of what is at the beginning, then any impairment losses, the movement basically. Beginning, addition, deletion, impairment losses, reversal of impairment or losses. So this disclosure is not applicable to level 4. And also there is an encouraged disclosure to give description of a fully amortized intangible asset that is still in use. This is limited. This is same as PPE, retired to use, and that is lying in the books of account. When we come to impairment of asset, level 2 and 3 non-company entities are allowed to measure the value in use on the basis of reasonable estimate. So you don't have to go for a valuer here unless it is mandated by some other law. You can actually determine on the basis of value in use. Consequently, if level 2 or 3 chooses to measure value in use by not using the present value, relevant provision of AS 28, which is actually discounting and all that future cash flow projection, all that will not be applicable, and the relevant disclosure is also not applicable. Also, in case of impairment of an individual asset or CGU, cash generating unit, is recognized or reversed during the period and is material to the financial statements, reportable segment, the segment related disclosures are not applicable, as AS 17 itself is not applicable here. Further, in case of CGU, you know, the detailed calculations and all that will not be applicable if you're choosing value in use as such, and the key assumption disclosure and all that is not applicable to level 3 and 4 of the entity. Now coming to the last standard, which is 29. So the movement in the provisions that we disclose, opening addition paid off during the year, so that is not largely applicable for 2, 3 and 4 entities. And also, you know, the detailed obligation, the uncertainties about cash flow, expected reimbursement, that table that we give in detail, that is also not applicable to 2, 3 and 4 entities. So let's quickly recap a few of the FAQs here. And after this, we will discuss. So this is about the applicability of accounting standard. Hope we all remember. I think I have repeated twice, but then this is just to remember that we all remember the levels of 1, 2, 3. So I'll just take half a minute for you to refresh. Level 1 is where it is listed. Any stock exchange in India, bank, financial institution carrying an insurance business, turnover 250, borrowing 50, and any holding subsidiary of the above. Level 2, 50 to 250 turnover and 10 to 50 borrowing. Okay, and level 4, level 3 is 10 to 50 and any borrowing more than 2 in the range of 2 to 10, and the rest is all your level 4. So let's look at some of the FAQs. Yeah. So first question is more on what is the date from which the new scheme of classification of non-company entities announced by ICAI on 31st March 2021 is applicable. It is applicable from 1st April 2020. That means from the beginning of that year when this announcement came into picture. So if logically asking 22-23 is the third year, 2021, 21-22 and 22-23 is the third year. Next year, there's a high possibility that it becomes a guidance note and you're mandated to follow this. Whether any changes in applicable accounting standards have been done? No. There is no change in the accounting standard that has been made. Only classification has changed, and also there is this exemption table that we discussed very much in detail, which is applicable over a period of time. The next thing is whether each non-company entity is required to comply with all accounting standard issued by ICAI. Yes, it is supposed to issue. It is supposed to be following the relevant standard along with exemptions. So there is nothing called no accounting standard is applicable to me, but it is more like this part of accounting standard is not applicable to me because I have got an exemption. So at all times, all accounting standards are applicable, subject to exemptions. Excuse me. Sorry. For the purpose of applicability of accounting standards, non-company entities are classified into how many categories? I think by now we have the answer. It's into 4 categories, right? Whether classification criteria is applicable to non-company entities who may be required to follow Ind AS. Obviously, the answer is no, because once it is an Ind AS company, it has to follow those standards and it has to be compliant with Ind AS at all times. Whether exemptions given to level 2, 3 and 4 can be applied partially? Yes, voluntary disclosure is possible. So whatever you do, you have to make a note and disclose. For example, what does this mean? So I've got an exemption in AS 10 on some retired asset and other things not being disclosed. If I don't want to take that exemption, I can give all disclosure. But then it is necessary for me to bring out in the notes as to what is it that I have exercised and what is it that I have not exercised. So I have taken exemptions under say 17, 18, 17, 22 and things like that, but I have not taken exemption under 10. That is necessary to be brought out clearly. Whether entity can decide not to avail any exemption and relaxation available to it. Yes, it can give full disclosure. Complete accounting standard applicable, full disclosure. I take an example here. For example, if you have a company, I'm not talking about a non-company for a minute, you're talking about a company. It is a private limited. It gets converted into public limited. And then after 2-3 years, it wants to go into IPO. So it has to start adopting to the best practices or standards. So it will give away all the exemption. It will start giving full disclosure. Similar is the case. If you're going to be part of a larger group, if you're going to be listed on any stock exchange, anything, and if you want to prep yourself 1 or 2 years before, then you can start doing it without any exemption. You can start disclosing everything that is possible. What is the authority attached to model financial statement? It is only for ease of use. What is the authority that is attached to the technical guide? It is for guiding the members. If entity was covered in level 2, 3 or 4 previously, but now it has been transited to level 1. So reverse of what we saw in AS 22. What are the disclosure obligations? In case entity is being covered under level 2, 3 or 4. So say for example, 21, 22 entity was level 3 and had qualified for exemption or relaxation, but no longer qualifies for relevant exemption in the current accounting period. Relevant accounting standards or requirements that become applicable has to be given very much in detail. The fact that level entity was covered in level 2, 3 in the previous period and it has got exemptions does not matter here. So what are we trying to say? In 21, 22, it was level 3. In 22, 23, it has become level 1. So the comparatives, you have to do it as per level 1, not as level 2 or 3. You can't say figures are not comparable because it was in with the exemptions. You have to call out those and you have to present those also. That is the thing that is being emphasized here. Who can use model financial statements provided in the publication? Everyone who is a preparer, who is an auditor, who is actually verifying it. Everyone can use the model financial statements or the technical guide on the financial statements. Which are the types of non-company entities who can make use of this? Proprietorship concerns, partnerships, LLPs, all can make use of this very much. Then whether it is compulsory to follow the non-company financial statement disclosures, as of now, it is in the form of technical guide. So it is not compulsory, but soon it will be guidance note and it will become compulsory. Disclosure requirement if entity's turnover reduces and cease to be that level. That means it was level 2, now it has reduced and then it has become level 3. Then what is the implication? If level 1 entity or level 2 entity has become level 3 or so it has fallen by a level. So entity will not qualify for exemption or relaxation until entity ceases to be covered in level 1 for 2 consecutive years. So reverse when you go, so what we saw in the earlier FAQ is that last year I was 3, now I am 1. So I have to give all disclosures for last year also. However, if I go from 1 to 3, then I have to observe for 2 consecutive years, then only start taking the exemption. Why is this amendment like this? Because there may be a possibility that due to some minor reasons or unforeseen reasons, right now it has fallen, but there is very much a possibility that it will rise. So that is why 2 years are given so that they can actually look into the assessment properly and then they can decide on whether it is still the lower level or it has gone to the upper level. So the 2 years waiting period is necessary. Can entity follow accounting standards on voluntary basis even if exemption has been given for particular standard? Yes, you are free to follow and you can disclose that you have not taken the exemption. What is the disclosure as per AS 27? Venturer has to disclose information required in para 51, 52, 53 in its separate financial statements. What is this para 51, 52, 53? It largely deals with how you have accounted for, and then what is your portion that is getting actually consolidated into someone else, all those details that you will have to provide. Whether AS 27 financial reporting on interest in joint venture applicable to level 4 entity. In case of level 4, generally there are no such transactions that are covered under AS 27. Therefore, this is largely not applicable. However, if you have these kind of transactions, then you have to follow the principles of AS 27. Whether non-company entity is required to prepare consolidated or interim financial statements, there is no obligation like that. But if you want to prepare, you have to follow AS 25. Please remember this way that, all these things are not applicable to non-company entities. However, if you are doing, then you have to follow the principles the way it is done for anyone else. You can't have another principle which is going out of the accounting standard. Does non-company entity which avails exemptions or relaxations given to it disclose the fact that it is an MSME? So both facts that it is a MSME and also that it has taken certain relaxations or not taken certain relaxations, disclosure is necessary. Otherwise, how will any reader understand? We have to give appropriate disclosure so that the users or the readers of the financial statements properly understand what is it. Yeah. What is the duty of auditor in case of financial statement prepared on basis of other than accrual? So when is it that other than accrual is allowed? It's almost gone out now. There is nothing called other than accrual basis as of now. So if the auditor sees that only in case of professional it is allowed, where books of accounts are not kept and things like that. So if it is other than accrual, then actually you become a question mark and you will have to guide it accordingly. So guidance note on tax audit also talks about this, and all accounts have to be basis of accrual. So you have to take care of this, and if this is the situation, then you have to give disclosure. You have to give a qualification on the accounts maybe. Who can use the cash accounting system? Professionals who have been using cash accounting system as per section 145 can only use, others cannot use, as you know. Depreciation rates. So this, I think 2-3 times we have taken this example. So even if it is non-corporate entity, you have to determine the useful life of the asset. You have to determine the residual value, and then you have to go and conclude on the depreciation. Please note, depreciation rate as per Income Tax Act is not something that is always applicable to all non-corporate entities. So there can be DTA, DTL arising out of it as well. So one standard leads to the other, and it is necessary that it is there. Whether UDIN is required for non-corporate entities which are not subject to audit. Now, if you are not doing the audit and if there is no tax audit and you are preparing only for the purposes, or if you are reviewing only for the purposes of bank or financial institution, but you are certifying it, you are required to issue a report under SA 800, which is audit report under special purpose financial statement. There, what is the content of SA 800 is that you have to ensure that there has to be a restriction on use para, the purpose for which these financial statements are written and are prepared. All these have to be mentioned so that you can be safeguarded that it is not freely used by the company and it is actually used by anyone and everyone without any restriction. It is necessary, so please go through SA 800 when you are doing specific purpose financial statement. Use only this format and not the general purpose financial statement as per SA 700. So SA 700 is general purpose financial statement, which is actually freely usable by everyone. 800 has got these restrictions. If tax auditor required to comply with accounting standards while carrying out tax audit under 44 AB? Yes, tax auditor is bound to comply with accounting standard. Also, if there is no audit that is done under any other law. So if you're doing 3CB, then you are supposed to certify the financials also, and you are supposed to certify the 3CD also. In that case, you are supposed to actually follow the principles of accounting standards. Then first portion of the form, because it talks about true and fair view of the financial statements, that is the accounting part. And then the second part is 3CD, which is true and correct of the tax audit report. So you have to accordingly take care, and you have to comply with accounting standard as well as the relevant auditing standard here. Is accounting standard applicable in case of charitable or religious organization? If any portion is actually pertaining to commercial, industrial, business activity, then accounting standards become very much applicable here. If it is not, then it is not applicable. However, if it is there, then it is definitely applicable to the relevant entity. So this is the flip book that is available, which is on the accounting standard. Now some references here. So let us look at the Excel file of LLP FS. I'm just opening this, and then I'll open the non-company FS also. So this is for the LLP.
Madam, you have
Change the
to.
screen. I'll change the screen. Yeah. It's just opening. Are you able to see the Excel sheet?
Yes, yes.
So this is in the form of a Excel utility, because generally we end up giving PDF and which is not usable much. So within the technical guide, you have a link to download the Excel also. And this Excel is actually linked everywhere, and you can put a TB and then link it. There's no TB obviously here. So you can actually put a TB and backlink it so that all the balance sheet and P&L and everything gets linked and your balance sheet is ready. So that is how it is made. Now, this is the header. Then you have the name of the entity and balance sheet and financial statements as you want to give the heading. Amount in rupees, whether it has to be in absolute, it can be in absolute. If you want to round off, no one stops you from rounding off. You can round off on the basis of principles that are given in Schedule 3 or as per your requirement. The format is largely in line with Schedule 3, but not the extra disclosures if you have to see. So let's go through the format. It's equity and liability, partners funds, partners. So we are looking at LLP now. So partners contribution, current account, if at all there is anything, reserves and surplus. Non-current liabilities, you have long-term borrowing, you have deferred tax liability, you have other long-term liability, long-term provision, current liabilities, short-term borrowings, and trade payable. Now in trade payable, what is outstanding due to MSME and non-MSME? Now this is not coming from Schedule 3, this is directly coming from MSME Act itself. That is why we have retained this. Other current liabilities, then short-term provisions. And under the assets, you have non-current assets and current assets. So non-current assets, PPE, intangible, CWIP, and intangible under development. Non-current investment, deferred tax asset, long-term loans and advances, other non-current asset. Current assets, current investment, inventory, trade receivable, cash and bank balance, short-term loans and advances, and other current assets. Then total, then there is, this is brief about the entity, summary of significant accounting policies. And then here you will be your entity signature block, then your signature block. UDIN does not come on financial statements. Please remember that UDIN is only on the certificates and reports that are issued by us. So UDIN will come on the audit report, but not on the financial statement. So this is our P&L, revenue from operation, other income, total income, then expense, cost of goods sold, employee benefit, finance cost, depreciation, amortization, other expenses, P&L before extraordinary, partners remuneration and tax, exceptional items, then P&L before extraordinary items, partner remuneration and tax, extraordinary items, then remuneration and tax, partners remuneration, profit before tax. Then there is tax expense, which is current tax, excess short of previous year, deferred tax charge or benefit, and from continuing operation, discontinuing operation, and then P&L for the year, and the rest of the things follow. Now, We start with note 3 because largely one is summary of significant accounting policy and one is brief about the entity and second is summary of significant accounting policy. This will have to be prepared. This is not given in the illustrative because it is too long to actually predict or too vague to predict what type of entity you are in and what are the things that are there. So this is partner's contribution. This may be different from entity to entity, but these are the maximum coverage that is given already. If you have any more variety, you can free to be adding it in. What is the agreed contribution, share of profit, as at April introduced or contributed during the year, remuneration, interest, withdrawals, share of profit, and as at a year end. Then partner's current account, you have similar structure there. Now, these are other notes, reserves, capital reserve, revaluation reserve if you have, other reserve, undistributed surplus if at all you have anything of that sort. Borrowings, secured, unsecured, term loans from banks, from other parties, loans that are repayable on demand from banks, from other parties, deferred payment liabilities, loans and advances from related party, long-term or current maturities of finance lease obligation, other loans and advances. Then unsecured, you have similar classification. Then briefly, what is the security, what is the terms, and then in case loans are guaranteed by partners, then what is it that the partner has guaranteed. Then deferred tax liability and asset, deferred tax asset, expenses, whatever the relevant expenses, doubtful debts, difference as such, gross deferred tax asset, and then DTL and gross deferred tax liability. Then you have other long-term liability, advance from customers, others, whatever you have to specify. And then provisions, provision for employee benefits, gratuity, leave encashment, and provision for income tax, net of advance tax, other provisions, and trade payables due to MSME or other than MSME. In case of MSME, the following disclosure, because that is coming from the Act itself. What is the amount outstanding? What is the interest? What is the delay in payment? And also you have to fill in that MSME one if you are a company. So this is for non-company. Other current liabilities, current maturity of financial obligation, interest accrued but not due, interest accrued and due, income received in advance, unearned revenue, GST, TDS, and other payables. Then we go to PPE. You know, you can do it horizontally or you can do it vertically as the case may be. And you have to give for current year as well as for the previous year. So accordingly, the schedules are available. And this is a small CV movement schedule. And this is intangible asset under development movement schedule. Investment is as per AS 13, wherever AS 13 is applicable. So quoted, unquoted, market price, investment in subsidiary holding, investment in other entities. So all varieties covered here, provision for diminution in value of investment, then investment in preference share equity, whatever is the classification that is as per AS 13. So the entire schedule is given here. So this is one for current and one for non-current. Similarly. Then you have P&L schedules, which is revenue from operations, sale of products, sale of services, grants or donations, other operating income, revenue from operation, other income, which is interest, dividend, whatever you have. COGS is kept brief. We have not kept it according to Schedule 3. It's a very brief. RM, if you have, you can put it. Otherwise, you can directly delete those schedules. Inventory, beginning, purchase, and moment and close. Then packing material similarly, other material similarly, and total material purchase of stock in trade. If you have, you can directly jump onto it. Finished goods, if you are having manufacturing also, because RMWIP and finished goods will come. So that's the closing stock. And then employee benefits, including contract labor. So whatever is the relevant employee benefits, salary, wages, contribution to PF, gratuity, staff welfare. Finance cost accordingly, interest expense on bank loan, asset finance, borrowing cost, and depreciation and amortization on tangible or intangible. And other expenses, which are routine expenses of the company or the factory, as the case may be. So this is largely about the financial statements. Now, what is the format of audit report? So I will quickly take 1 minute to show you the audit report format also. Yeah, in the SA 800, that is general purpose financial statements audit report. Yeah. Let me know if you can see illustration 3.
Yes.
So this is something that deals with non-company entities. So it is ABC and Associates. So this is the format for audit report. So please don't carried away by the old formats. This is the new format and it is very much there in SA 700 illustration 3. Management responsibility, auditor's responsibility. Okay. This is very important because we are not giving IFC report. Opinion. Okay. We will have UDIN also here. If it is qualified opinion, it will come accordingly. Now, what is the catch here? Because this is the old format, you have to convert it into the latest format. Yeah. So your opinion has to come above. I think by mistake. Just give me a second. Yeah. I opened the wrong old standard. Maybe. Yeah, this is the latest one. This is illustration 2 and this is illustration 3. The unlisted prepared according to this. So you have to use this format. If it is opinion, you have to give the opinion first. So instead of company, you have to change it to the non-corporate entity. So this format is available in model financial statements of WRC. Technical guide, this format is not there. You can pick it up from there as well. Yeah. So this is something that you will have to follow. This section will get deleted because there is no requirement under any act to provide this. If whatever you are auditing, say AIF or something, it has specific reporting requirements, then it will come here. Otherwise, this section gets actually deleted. Yeah, this is there. Illustration 4, which is non-corporate entity. You can directly pick up from here as well. If you want to edit that you can do, or you can directly pick up from here also. I just got 1 minute confused into the appendix number. I'm sorry, it was appendix 3 in old essay, 4 in the new essay. Sorry for that. So this is the auditor's responsibility and this is how it is. The opinion, basis for opinion. And if it is a qualified opinion, it has to accordingly qualified opinion, basis for opinion. So the legal and regulatory section is not here. If you want to include, if you're doing a fund or something, then you will have to include it. Okay. So I think yeah. So these are the links in the PPT which you can use. This is LLP, this is non-company FS.
Padmashi, your screen is on that.
Yes, it's coming. It's coming. Can you see now?
Yes.
Yeah, thanks. So these are the links for various publications: technical guide on LLP, technical guide on non-LLP, and model FS. Here you can get the audit report also, but SA 700 revised illustration 4 is the format for your ready reference as well. So some important aspects into audit documentation, because we believe that audit that is not documented is work not done. Work not documented is work not done. Ensure that you have you are responsible for preparation of audit document. It has to be adoptable for historic financial information, laws and regulations, if at all something is that is applicable, specific documentation requirements. It helps in planning, supervision, results in better conceptual clarity, facilitates better understanding, supports evidences, as you know. Audit documentation for smaller entities, it is written in the standard that it is generally less extensive. Record various aspects of the audit together with the document. Examples are various. We have discussed a number of examples here. Ownership and retention, every documentation that you do is the property of the auditor. You can share it with someone, you may not, you don't want to share it with someone. You're obligated to maintain all audit documentation for 7 years from the date of audit report. So I think largely that is what I had to share. So open for questions. I think we have few.
Yeah, so we have few
We have few
questions on.
questions. Yeah.
Yeah, we have few questions on Q&A sections, and we request participants to raise hand if they want to ask questions in person. Deepak, can you take the questions from Q&A?
Yeah, okay. First question from Dhaval. ASN Schedule 3 are enforced through Companies Act. The responsibility of the preparation of financial statement is of the management. How can financial statement format and AS applicability be enforced on non-company entities?
So for companies, it is through Companies Act. NFRA is the body who can actually make accounting standards, auditing standards, and things like that. And also Companies Act has the authority. So the accounting standards in Companies Act come through accounting standard rules. However, for all other entities, ICI has the jurisdiction, and they are supposed to, they are actually working as the entity which actually enforces accounting standards. So accounting standard is for better preparation, presentation, clarity in the overall perspective. So the objective of ICI, if you take a step back, before 2013 Act, accounting standards, auditing standards had always come from ICI. After the accounting standard rules got incorporated, it is much through Companies Act. But then, for all other entities, it is the responsibility, or somewhere it is the the main responsibility that is handled is that the users of the financial statements understand the financial statements, and we as auditors, when we are preparing the audit report, that is when we are doing the audit and preparing the audit report, we have to have true and fair view. How will we give true and fair view if no accounting standard is prepared? So even if we are saying that how can you impose accounting standard, I'll go a step forward and ask, like, then why is it that going concern, accrual, these things are even followed by us? So based on these principles only, we are giving the true and fair view. So that is how it is through this, it is getting imposed. And they don't, ICA don't have jurisdiction over these companies. So maybe through us, if guidance note is there, then we are bound by it, and we will have completely, able to ensure that it is complied with.
Okay. One question not related to the topic directly, but I have a confusion. What is operating lease and finance lease? So I think.
Yeah, so operating lease and finance lease is always a debatable topic. I can say when you classify a thing into operating lease or when do you classify something into finance lease, It depends on the terms and conditions of the lease, whether it is cancelable, non-cancelable, whether it has a feature of buyback, whether it is long-term, short-term, what is the residual value at the end of the lease period and things like that. I am not sure of what your contract is into and what is your specific, confusion is into. But then I think definitely if you put those 5 conditions into a table and take your agreement and put your clauses of the agreement against those 5 conditions, that's how I have been able to before Ind AS, before Ind AS came into picture, that's how we all have been able to understand whether it is operating lease or finance lease. And sometimes some clauses are made in a way that it doesn't fall here, it doesn't fall there, but you will have to then fall back on some of the EACs and things like that to take I would say conservative view maybe.
When you bring the index, it will complicate it more further.
Yeah, because there is no concept as such of operating
Yeah.
finance now after the said standard got amended, isn't it?
Couple of participants have also raised their hand. I'll just complete the question which are there in the Q&A section, and then I'll allow the participant to raise their question. Question from Dev. A firm has a subsidiary, therefore firm becomes level 1 entity, and therefore AS21 dealing with consolidation becomes applicable. The firm has no obligation to prepare CFS under any statute. In that case, whether it is mandatory for the firm to prepare CFS, and if yes, what actions are required by the firm after preparing CFS?
So if it is not obligated under any statute, then it is not mandatory. If you want to, because some people, they want to look at their total net worth, or they want to look at their ability to go ahead or to borrow something and things like that. So they use it as a route. But if there is no need, then you're not obligated to. If you're preparing, then yes, you have to follow the principle of AS21, which is line by line consolidation, calculating goodwill and other things. All those things come into picture. But if you are not obligated to, it's not necessary.
Okay. In case the non-corporate entities does not comply with one or more accounting standards, is there any other remedy with auditors other than to qualify the audit report which is in Form 3CB?
So we are supposed to give a report that is true and fair view. And accounting standards has level 1, level 2, level 3. Auditing standard doesn't have level 1, level 2, level 3. Professional skepticism doesn't have level 1, level 2, level 3. It has to be the same. Fraud can be there in a small entity, in a big entity, in a very large entity, depending on the intention to deceive, right? So standard of auditing doesn't give you that leeway that it is under a financial reporting framework. So financial reporting framework in the given case is accounting standard. It is non-compliant with accounting standard, then you have to qualify. It is like in case of tax audit, if it is non-compliant, if one of the clauses is not properly disclosed, or the amounts that are disclosed are not something that you believe is right, then you qualify. So there is no other remedy basically. Rather, I would put it this way, that we should not look for remedy because we are independent auditors. If we start looking at remedies, that is what will make their life easy and our life difficult. And in today's world, you see every day morning when you wake up, either there will be a news article or a WhatsApp forward which says this practitioner is debarred, that practitioner has been laid down some fine. Left, right, and center, there are these things that are happening. Disciplinary mechanism is revamped. So there is so much responsibility that is sitting on our head. So I think we have to live up to that.
Okay. Can a cash accounting system be used by charitable organization?
I don't think so. It can be used by anyone else other than it is 145 professionals where it is allowed. It is not allowed by anyone else as far as I understand.
A recent question by Manikanteshwara ji. Recently, I have been approached by a sole proprietor concern asking me to sign the financial statements prepared by them. I have turned down the engagement, quoting that it is mandatory for member in practice to comply with accounting standard. While okay, it's just sharing of the views.
Yeah, it's good.
Appreciate
So
it.
it is like only, I would put it this way, I think I'm happy to see these kind of views because it's like this, that when we deny and if we go somewhere else, then if he gets it done, then it is not good for us. We all have to deny. Then only they will come up to the speed and they will say, okay, you do it the way you want. Otherwise, if I deny, you certify, then there is nothing that we are doing there.
Do we need to give audit report as per SA 700 along with 3CB, 3CD?
So there are mixed practices here. Many firms do give one pager, the 700 report or the 800 report along with 3CB. And there is another thing that is written in the guidance note on tax audit itself. It gives both options. It also says that in your 3CB, in the drop down, you put the auditor's responsibility, management responsibility paras therein. So actually the basic thing is that you have to be compliant with the standards of auditing also. Either you put the paras there or you issue another report and put it as an attachment along with P&L and balance sheet. No one stops you because all the attachments that are there along with the 3CD that you are uploading is all forming part of your 3CB and 3CD, right? So when you're scanning and putting in your balance sheet, if you put one page report also, no one is going to obligate to it. And then that is not something that you're doing otherwise. So either put those paragraphs into the main report as such, or you include it as an attachment. Both practices are parallelly followed.
Correct. Also, I would like to add about that TAQRB, wherein
Yeah,
the chairman in 2 or 3 sessions and under their publications also they have suggested to incorporate this exactly the second method which you suggested, to incorporate the auditor's responsibilities and management responsibility in the format of 3CB itself. And
correct,
that's what they have suggested for all of us to go ahead with.
So
correct,
even
correct.
just wanted to share that as an office, we also follow this practice. We have modified Form
same.
3CB, wherein we have included the relevant paras from SE.
Yeah. So it stays within. That is why it is important, because that auditor's responsibility and management responsibility actually calls out what you are not obligated to and what you are
Correct.
obligated to. If you don't put that, then you are actually open-ended. You're exposing yourself too much.
Correct. Next is EMI payable to bank for next 12 months, which is basically current maturities for long-term debt. Now should be categorized under other current liability or the short-term borrowings.
So there's a
I think with
specific
the amendment,
place there for current maturity of long-term debt. You can just place it there. In the Excel, you can just search for it.
and considering the Schedule 3 amendment last time, I think short-term borrowings is the place where they have regrouped it right now.
Yeah, yeah.
In case of deferred tax provision, which is practical and correct way, go by the net WDV of assets as per IT and books, or go by depreciation charge for the year.
So when you're preparing the books of accounts, it is accounting standard you have to follow, as I clarified. So please go by the accounting standard and then do a calculation of it as per Income Tax Act, and the difference gets charged out to DTA, DTL, as the case may be.
Basically, they are asking whether to follow the PNL approach or the balance sheet method approach. So
as per accounting standard, both are
Both
allowed, because under Ind AS, the
balance sheet
earlier
is
method is not.
compulsory.
Yeah, the P&L approach is not allowed.
Why transitional requirement with respect to deferred tax is only applicable to level 4 entities and not other level of entities?
Yeah, that is because for level 4, there is no DTA that is applicable. So that is why if when you become level 4 from 2 or 3, then the rest of the DTA you charge off to opening reserves. That is why it is there. Till you become level 4, DTA, DTL is applicable to you. When you come to level 4, only current tax is applicable to you.
If a company has purchased a domain name for 10 years, is this an intangible asset or an prepaid expense?
This is, I think this needs more facts here.
Yeah.
So what is the
Not
purpose
related.
of the domain name? What is the extent of use? What is the benefits that are flowing and all that? So, and as such, there is nothing called deferred revenue expenditure, as we know. So either it is an expense or it is a intangible asset. So there are lots of conditions that will have to be evaluated, and I don't know, I can't answer like that.
Now the two participants are there who wants to talk. I will be allowing them. Mr. Nikhil Patel, you have to unmute yourself and ask the query.
Yeah, ma'am. My question is, when we are converting into this new format, as we see, it talks about current, non-current. So, for example, when we have to do audit of non-corporate, it's essentially like, let's say, gratuity trust, which is many of the corporates have. So, when we do the audit, the issue comes, how do you classify into current and non-current? Because you can't properly estimate how much of the gratuity will fall due. So people leave, something will be due within a year. So that is where I am in a dilemma.
So you're talking about non-actuarial provision, right?
Yeah. As a gratuity trust, what happens? You receive money from the company and then you put into the policy with LIC, etc.
Acha, gratuity trust. Okay.
Trust, yeah, gratuity superannuation trust, there are separate trusts. So these are all non-corporate entities. So when we try to, currently I have got it and assignment, which I am doing.
So
I
what is
have a
current and
dilemma.
non-current portion out of the things
issue.
that you hold?
Yes.
So you're talking about assets there or liability side?
Both. But there are both.
Yeah, so gratuity trust, I think based on experience, the percentage is classified, and it is like based on the historical trend that how much are the claims and how it is. So a percentage is allocated to current and rest of it is carried as long term. That is the general practice that in the larger trust that I have seen. You can look at a trend as to what is so 100 is your total assets, for example. Out of which how many assets you had to dilute during the year. If you take a past trend of 3 to 5 years, and then you will have to give a note accordingly. So say, for example, 20% is something that you're diluting every year and 20% you're refilling. So 20% becomes your current and rest of it becomes long term. This is one practice that I have seen in few of the larger trusts. So not saying that is the only practice that is available, but this is one practice. And there are people who will hold everything as current because it is something that is obligated, that if the employee asks me, it is as if as good as repayable on demand. So everything becomes that way. And there is another school of thought also that exists, that because I'm holding these assets for long-term gain and ensuring that the trust runs well, I'll put it everything under long-term. But the midway is something that is actually largely acceptable, logical, is that the percentage that I'm going to dilute is something that will be current and based on historical trend, because there's no hard and fast rule under the gratuity act or anywhere that how do you hold a fund or how do you classify the fund, but it says that you will have to, and also the employer has the obligation to make good any losses. Say in case if you put it into an equity share, if the trust allows, and then if you lose money, then the company is obligated to make good whatever
Compensate
it
the loss.
loses.
It's true.
Yeah.
It's true. No, but as you were just now saying that some companies show everything as a current as it payable on demand. But actually, when we make a gratuity provisions, or even when you have a policy with LIC, now even if somebody has joined just 2 years back, and let's say his age is 30, he's presumed that he will retire at 60 only. And
No,
accordingly, liability we provide. So my
No.
view is I can't show everything in the current.
Mm,
I agree
I
with
agree.
how to break up into the current and non-current based on some proper ways. So what you were suggesting based on past 3 years, 5 years record,
Yeah.
5%, 10%, whatever comes, I think to me it appears to be the better option.
If you have invested with LIC, now I have a simpler way for you. You
I'll
ask
tell you, ma'am, my problem is, see, we have given money to LIC. I have a policy. So actually, whoever retires, LIC has to give me the money. So on my asset side is my
understand.
fund with the LIC. Now
So-
I have 100 rupees with LIC. How much I should show under the current and how much I
That's
should
what
show
I'm
under
saying.
non-current? That's my dilemma.
If you have it with LIC, then I'll give you a simpler solution. Ask LIC to divide it into current and non-current, because they do it on the basis of actuarial
Some
valuation. They
actual
will do it
valuation.
and give it to you.
So what we do for the
That's a
corporate,
much-
similar things we need to do for them.
Yeah, that's a very simpler solution. I thought
Right.
you are managing the assets. That means the company is
No.
managing the assets.
We have
and the
taken
company
a,
is-
this client has taken a policy. with
That's
LIC.
easier because they do it
Yeah.
on the basis of actuarial valuation. You ask them what is current, non-current, they will immediately give you the, split. That's easier
Yeah.
for you.
Yes. Yeah. Thanks.
Welcome.
Thank you. Mr. Pukhraj, I'm allowing you to talk. You have to unmute yourself. Mr. Pukhraj? I think you're not able to. I will allow Mr. Mani Kanteshwaraji. Hello.
Yeah, like I've got a client where it is incorporated in the current year and promoters have incurred their expenses prior to incorporation on behalf of for the purpose of company. Now the company wants to reimburse this and account for these expenses. Like what will be the proper things to do?
Sorry, your voice was completely breaking. Couldn't hear you. I'm sorry.
Yeah. The company has been incorporated in the current year, ma'am,
Yeah.
and promoters have incurred expenses on behalf of the company prior to incorporation.
Huh.
Now
Okay.
after the incorporation, company wants to reimburse the promoters all these expenses.
Huh.
And is this like how to is it proper for a company to account for these expenses?
Yeah, it's pre-incorporation expenses is allowed. If you're talking about a company, you can very much get it done. There's no issue.
Okay. Also, like even after incorporation, directors are incurring expenses on behalf of the company through their personal credit cards and these things. Like, does this fall under related party transactions?
Yes, it will. It will. Whether it gets reimbursed or otherwise, it needs a disclosure and it will fall under related party transaction. So there are cases where, initially bank account is not opened, few of the transaction directors do. Sometimes they take reimbursement, sometimes they don't. But either ways, it is a related party transaction, it needs a disclosure.
And the last and final question, like I am the one who asked about the domain name. Like they have even developed a website with that one. And the purpose of this website is to drive sales and advertisement purposes.
You have to do a benefit analysis. What is your, advantage spread over? So more it seems like an intangible. It may not have a specific header, but then it seems like an intangible. Once you do the analysis, then you can look at as to what is the benefit that you are deriving. How is it that you are spreading your, direct matching of the expense income? All that after you do all that, then you will be able to decide.
Okay, ma'am.
Mr. Dev? Yeah.
Hello.
Yes.
Yes, Mr.
Hello.
Yeah.
Hello. Am I audible?
Yes,
Yes.
Mr. Dev,
We
you're
can
audible.
hear you.
So my question was, if I was a level 1 entity in the first year and then I have shifted to level 2, 3 and 4 for 2 consecutive years, then only I will be eligible to claim all the exemption, correct?
Correct.
And in that case also I'll have to revise my comparatives for the previous year because there were no exemptions availed. So then why we cannot do the same in the first year itself? Why we'll have to wait for 2 consecutive years?
No. When you take exemption, there are certain things that you will, invariably change. So it will be applicable for the current year also and last year also. So it's not only about comparative, it is for the current year also. So why wait for 2 years is, it is possible that only 1 year you may have had a dip because of some issues, and then you may come up. So again, taking exemption, downsizing everything that you are disclosing and doing the accounting, and then again coming up will become an issue. That's why the logic is you wait for 2 years. If you're still seeing a dip, then you go back to that.
Okay, thank you.
Welcome.
There are a couple of more questions and also one question on chat.
Yeah, I'll take that. Does the investment in firm or LLP as capital contribution should be disclosed in related party disclosure?
So if you're talking about my share in my partnership firm, it comes in partners contribution. But if I'm partner in another firm and then I have some transaction between this firm and that firm, then that will come into related party disclosure.
Okay. Scenario, individual with share transaction as business income, F&O. So in F&O transaction, if it exceeds the turnover limits for tax audit, should AS be followed for such individual? Question is not very clear. Basically, I think
No, I couldn't understand it. So
But
if
let
tax
me-
audit is applicable, whether accounting standard is applicable. So whenever you prepare any balance sheet, anywhere accounting standard is applicable.
yes. If the question is in relation to level 1, level 2, level 3 classification and what turnover should we consider for that, if that is the question, then whether, so basically for F&O, turnover is calculated separately from income tax point of view.
Yeah,
And
I'm not an expert in that. You can.
yeah, so basically, under Income Tax Act, in the F&O cases, whatever is the profit or loss, that profit or loss amount at the transaction level should be added and turnover is derived and not the transaction value for the purpose of income tax. So I think the question is whether this turnover as per the income tax laws should be considered as turnover in determining level 1, level 2, level 3, or the transaction value should be considered for F&O in cases of individuals. This is the question.
So here, I think there is an interpretation issue as to what is turnover. If
Yeah.
turnover is the question, then whatever you are terming legally as turnover is the turnover. So if that is the way you have to calculate turnover for a certain entity, then that is the turnover. For example, in some cases, you calculate the turnover only on the basis of the commission or the net margin, and then grossing up is allowed in some industry, not allowed in some industries. So if grossing up is allowed, then your turnover is on the basis of that.
One last question. I think it's in relation to that gratuity question, LIC. If policy of gratuity is taken with LIC, why would it be required to show as an assets and liabilities in balance sheet? If liability arises, it will be paid by LIC.
Absolutely. This is one thing that always exists, that if I have a policy, why am I obligated to show it? It is your asset, it is your liability. Balance is only what you pay to LIC as premium. Try this, don't pay premium for 1 year. They will give you less claims. So basically, it's your asset, your liability. You have to disclose it by way of a note in the financial statement, and then the balance of it which you pay as a premium is the additional provision that you are creating. Forget LIC for a minute. It's like 100 rupees you hold, 80 rupees is your asset. 100 rupees is your liability, 80 rupees is your asset that you are holding. You have to make good 20. It's the same fund. So it's your asset, your liability, and you have to disclose.
Okay. I think all the questions are answered.
All questions answered?
Yeah, all questions are answered.
Great.
So friends, we all will appreciate Padma Shri has taken the presentation in very lucid manner, and we are really grateful for that. Deepak, may I request you to propose a formal vote of thanks to Padma Shri before we close the session?
Yes, sure. Pleasure. So thank you, Yogesh Bhai and Chambers, for providing me this opportunity for giving vote of thanks to our learned speaker. As introduced, she is the one who has been part in bringing the technical guide to us. And what better presentation it could be than hearing right from her. She had covered all the basic aspects of the applicability of accounting standards, on level 1, level 2, level 3, and level 4 clarification. The way she has given, the presentation in a lucid manner along with all the links, which will be very much useful for everyone. And the season is also going on. So definitely everyone will be much benefited from this session. And all the practical FAQs and the question and answer session which we had. So definitely it was a very good session. And on behalf of Chambers and everyone, I'd like to give you a virtual vote of thanks. Thank you very much.
Thank you so much. It has been great speaking here, and thanks for all the questions. There are many questions that we keep thinking about, and I think it is always good to share more and more knowledge. That's how I learn, and I take back also a few of the answers here. So I think that's wonderful, and thanks a lot to CTC and Yogesh and Deepak for all this. Thank you so much. Thanks
Thank you.
everyone for patient hearing.
Thank you.
Thank you.
Close the session.
Yeah.